Hello everyone. Welcome to the Forexer channel. Trading based on bare price action is a superior approach because it allows you to predict the movement of the market by focusing only on what really matters, the price. In this video, we've compiled some of the coolest signals and techniques we've discovered over the years of trading. These techniques have been effective in real market conditions. Today, I'll walk you through how to identify these patterns in your charts. Understand the psychology behind them and use them to make informed trading decisions. As always, please support our channel by hitting the like button and subscribe if you are new. We regularly publish advanced trading concepts and strategies that can enhance your trading skills. Welcome back, and let's get into the number one price action signal, the inside bar confirmation. Imagine we are in a ranging market where the price has been trapped in a box. Then, it breaks and closes above the resistance level, indicating that the buyers have overcome the sellers and the market can continue pushing upwards. However, how can we ensure this break is valid and not a failed breakout or manipulation? Because the market can easily return to the range and continue pushing downwards. So, one of the ways to validate the break is to wait for a pullback and rejection to indicate that this level will hold. However, the problem is that this pullback may never come, and we can lose a great trading opportunity to go long. So, this is where the inside bar confirmation comes in. An inside bar consists of two candlesticks. The first one is called the mother candle, which is big and large, and the second one is smaller and located inside the mother candle. The inside bar formation indicates a period of indecision in the market. In a bullish trend, it reflects that the bulls are not buying further in the second period, represented by a small red candle on the second day after a strong uptrend. In the case of a bearish trend, it means that sellers are not in control of the market anymore, and a small green candle reflects this after a strong movement. How does it help us assess the validity of a market structure break? Well, if an inside bar forms after breaking a market structure, it shows temporary indecision in the market. If the price breaks this pattern to the upside, it shows that the sellers tried to push the market back inside them, range, and they failed. So, it is another confirmation that this breakout is valid, and the price has a higher chance to continue pushing upwards. On the 1-hour chart of the Dow Jones, the market has encountered resistance twice, which it has rejected. However, the market then breaks through this resistance level and forms an inner bar candlestick pattern. This pattern indicates that sellers are trying to push the price back below the resistance level. If the market breaks above the high of the parent candlestick, it indicates that buyers have taken control and confirms the validity of the breakout. As a result, the price is more likely to continue its upward trend. Certainly, let's move on to the next signal, which is number 2, fakeouts. A fakeout, also known as a failed breakout, occurs when the price successfully breaches a structural level, but quickly retraces back into the previous trading range. Certainly, let's discuss the scenario where we are in an uptrend. Imagine we are in an uptrend, and the market successfully breaches a resistance level. In such a situation, if the market retraces back to this area, the previously encountered resistance now acts as support, and we anticipate a bounce or rejection from this level. However, if the market doesn't just retrace to the former resistance level, but continues to break right through it, we refer to this as a fakeout. This occurrence suggests a substantial shift in momentum in the opposite direction and can serve as a signal for a potential change in the overall market direction. On the 15-minute chart of Bitcoin, the price has recently broken below a support level. In this situation, it's common to anticipate this area to function as resistance, causing the price to be pushed lower. However, in this case, the expected resistance doesn't hold, and the price returns back into the previous trading range. This indicates the presence of buying momentum and pressure in the market. As a result, it is reasonable to anticipate the price to continue its upward movement from this point onwards. Additionally, when we examine the 1-hour time frame, we can observe that the higher time frame direction is bullish. This is because we have recently broken above a significant structural level on that time frame. Taking into account the directional bias from the higher time frame and the entry signal from the lower time frame, we could anticipate the price to continue moving upward. On the 15-minute chart of gold, we have experienced a fake-out. However, what makes this fake-out interesting is that it occurred after encountering a higher time frame demand area. This double confirmation suggests that the short-term downtrend is likely coming to an end, and we might see a reversal in the price. It's important to remember always to exercise patience in trading. If a trade does not align with your trading plan, you have the option to pass on it. Now, let's move on to the next signal. But before we continue, if you'd like us to create more videos more frequently, please support us with your likes and comments. Signal number 3, double top and double bottom entry. A double top or double bottom is a well-known reversal pattern characterized by an M shape or a W shape in price action. Traders commonly utilize this pattern in their analysis. Whenever a double top pattern forms on the chart, it indicates that the price has failed to establish a new higher high. This failure can occur for various reasons, such as a loss of momentum, a shift in market structure, or reaching a key level on a higher time frame. The most conservative approach to trading this pattern is to wait for the price to break below the neckline. This breakout serves as a confirmation of the reversal. The challenge with entering the market after the neckline break is that the stop-loss level can be quite large. Therefore, a common approach to trading this pattern is to wait for the price to pull back to the neckline, and then look for candlestick rejections as entry signals. However, it's important to note that this method may cause us to miss the trade if we don't observe a favorable candlestick formation. This is how we trade the double top and double bottom patterns. We combine these patterns with the 618 Fibonacci retracement to optimize our trade entry. After the neckline break, we use the retracement tool, which can be accessed in the Indicators tab, and apply it from the start of the movie to the end. Then, we place our sell limit order precisely at the 618 retracement level for short trades. Some of you have been asking in the comments about using the retracement tool and how to determine the end of a movie. The answer is that we will never know for certain every time we place the retracement tool. If the market chooses to move deeper, you should adjust the tool with the latest movie and wait for a pullback. It's important to remember that if we don't get a pullback and the price reaches our target, there is no point in continuing to look for a trade. The same concept applies to the bearish scenario as well. In this case, when the price rejects a level twice and completes the pattern by breaking above the neckline, we apply the Fibonacci retracement tool. We then place sell limit orders at the 618 retracement level, setting our stop loss below the swing low. Our target will be the next level of market structure. But here comes an important point. Trading every double top and bottom in the middle of nowhere isn't effective. The best approach is to mark a higher time frame key level that has repeatedly rejected the price. Then patiently wait for double top or bottom rejections in the lower time frame. On the EUR/USD 1-hour chart, we've identified a significant level of market structure. This level has recently played a role as both support and resistance on multiple occasions. Our strategy now involves waiting for the market to enter the supply area. Once it does, we'll be closely monitoring for the formation of a double top reversal pattern. This pattern will signal an opportunity to enter a short position. Let's zoom in on the 5-minute chart for a closer look. Here, we can observe that the market has formed a double top pattern, breaking the neckline to the downside. To execute this trade, we employ the retracement tool, starting from the beginning of the move to the end, and then place our sell limit order at the 61.8% retracement level. Stop. Loss is set above the swing high, and we target the next level in front of the price, creating a risk-to-reward ratio of more than 1 to 2. It's important to note that this setup is not limited to this specific technique. You can use multiple price action entry signals, such as this long wick, rejection candlestick, to initiate trades. However, a crucial point to remember is that to assess results and gain confidence in your trading setup, you should conduct your own backtesting across various currency pairs. Number 4. Shrinking candles. Shrinking candles refer to a scenario where the candle's body gradually decreases in size as it approaches a supply or demand zone. On the chart, you can see that the price moved upward, touched, and then reversed, establishing a key level of resistance. Observe how the candle's body gradually diminishes in size as the price approaches this level. The psychology behind these shrinking candles is that they indicate a loss of momentum among buyers, resulting in a shorter distance covered by the price. This serves as an early signal that buyers are relinquishing control, and there's a potential for prices to reverse from this zone. Now, this pattern is most effective when it's complemented by another reversal pattern, such as a doji candle or a long wick rejection, at the endpoint. And please remember, the same concept holds true for the bearish scenario. Number 5. Momentum candlestick pattern. The momentum candlestick pattern consists of 2 consecutive candles, where the body of the second one is larger than the first. The psychology behind this pattern is that it signifies a strong influx of momentum into the market. This suggests a likely continuation in the same direction for the price. It's important to note that this pattern works best when the larger candle has no wick on the top, indicating that buyers were active until the final moments of the candlestick period. Additionally, always consider it a trading opportunity when this pattern aligns with the prevailing market trend. On the GBP/JPY 1-hour chart, you can see examples of the momentum candlestick patterns. Pay attention to how the price experiences an increase after these candlestick patterns form. While these signals alone may not be sufficient for placing trades, combining these concepts will provide a foundation for making well-informed trading decisions. Number 6. Rising and falling wedge patterns. A wedge pattern represents a consolidation period where the price forms a narrowing structure, identifiable by 2 trend lines. What does this tell us about market participants? It indicates that the market lacks a clear direction, and buyers and sellers are engaged in a battle for control. Breaking above or below the trend lines reveals which side is gaining the upper hand. Breaking above the falling wedge in an uptrend signals a continuation to the upside. Similarly, breaking below a rising wedge during a downtrend indicates that the price is likely to continue its downward trajectory. But the question is, when exactly should we take the trade? Because sometimes these breaks could be a fake out, and the price returns inside the range. Now, here's how we approach this trading opportunity. In the bullish scenario, our first step is to break and close above the falling trend line within the previous market structure. This rule confirms that the market has the necessary momentum to continue upward. After this break, we'll actively seek entry opportunities to open a buy position. Once again, there are various entry signals to consider. You could wait for the price to return to the trendline area and look for signs of rejection or candlestick reversal patterns. On the 1-hour chart of gold, we have a bearish directional bias established by a higher time frame. Within this context, we can identify a wedge pattern, indicating a period of market indecision. Subsequently, the market breaks to the downside, signaling that sellers have taken control. Furthermore, we observe a break and close below the previous market structure, which serves as the second confirmation of this bearish trend. Now, let's apply the retracement tool and precisely place sell orders at the 618 Fibonacci level. On the 1-hour chart of Bitcoin, we can clearly observe a downtrend. Following this downtrend, there is a period of consolidation, and we are currently seeking an opportunity to enter a short position. Now, let's zoom in on lower time frames to examine more closely the details of the price action. On the 15-minute chart, we can observe the formation of a rising wedge pattern. Breaking this pattern to the downside signals the potential for a bearish continuation. Number 7. Combining high-quality signals. The most effective trading setups are those where multiple high-quality signals corroborate each other. This synergy between signals offers a strong and dependable indication of market direction or potential price movements. In this example, we have a high-quality trade setup. Let's break down the price action signals individually. 1. We observe a clear, continuous downtrend, marked by lower lows and lower highs, indicating the dominant trend. 2. There's a key level of market structure that has recently rejected the price multiple times. 3. We find ourselves at a trend line with several recent reactions, providing strong bearish confirmation. 4. Shrinking candles as the price approaches the key level signal a loss of momentum. 5. The market has formed a double top pattern, suggesting a potential reversal. 6. A long wick candlestick pattern appears at the point of multiple confluence, showing reactions to the area. 7. An engulfing momentum candle confirms the bearish pressure, serving as another strong entry signal. Considering this comprehensive list of factors in our favor, this trade setup qualifies as a high-quality 5-star short trade opportunity. An essential skill to develop is the ability to wait for high-quality trades while filtering out the low-quality ones. It's a critical aspect of successful trading. I hope this video has provided value for you. If it has, please show your support by liking the video and subscribing if you're new. See you in the next episodes.